In recent years, tensions between the United States and China have dominated economic headlines. We have seen the rise of Donald Trump and his implementation of trade tariffs against Chinese products. Subsequently, the succeeding President Joe Biden has also taken action against China. He has raised tariffs on various goods and even conducted semiconductor export controls, which are now limiting some of the most advanced and sophisticated semiconductor chips out there. These chips are crucial in growing modern economies as they enable the development of key technologies such as artificial intelligence, advanced telecommunications, and cutting-edge defense systems. These actions have then led many to believe that the United States government is doing what it can to curtail China's growing global power. But what's far more interesting about this case is that many people are seeing a similarity to China's economic rise and the US government actions, and that is in an economic powerhouse known as Japan. Japan, back in the 20th century, was one of the world's rising superstars and was once believed to catch up to the United States. Here's a comparative graph on the gross domestic product, GDP, of Japan compared to the United States in the 20th century, data from the World Bank. As you can see, Japan's economic output nearly rivaled that of the United States in 1995. Japan's GDP at that time was over $5.55 trillion, whereas the United States with $7.64 trillion. The difference that year was very minimal, and evidently more so when we compare it to their economies back in the 1960s. In that year, the US had a GDP of $541 billion, but Japan only had $47.42 billion. The difference here is big, and in just 35 years, Japan was able to close the gap. And it's not even just GDP. Here's another graph on their GDP per capita. As you can see, Japan's GDP per capita had actually surpassed the United States, a feat that only a couple of economies was able to do in 1995. This economic rise was driven by various factors, ranging from government policies which focused on industrial development, technology exports, and a strong emphasis on high-quality manufacturing. During this expansion, however, Japan had accumulated a significant trade surplus with the United States, particularly in industries such as automobiles and consumer electronics. That is when Japanese automotive companies like Toyota had been winning significantly in US markets. Here's the US car sales by market share in 1970. As you can see, Japanese car sales were minimal. They weren't being sought after by US buyers. But if you fast forward to 1995, you get to see a far different picture. While Japanese car makers still weren't as big as local American automotive brands, their presence has, nevertheless, enabled Japan to accumulate trade surplus with the United States. On top of Japanese car makers, there were also consumer electronics and semiconductors. Companies like Sony, Panasonic, and Toshiba became global household names, while Japanese semiconductor firms like NEC and Hitachi began dominating the global chip market. By the late 1980s, Japanese firms controlled over half of the global semiconductor market. These successes in key industries fueled Japan's economic rise, making it a formidable competitor to the United States. And as we take a look at this graph right here, we get to see just how much of a trade imbalance there was between the two nations. The graph from 1985 to 2000 shows the trade balance between the US and Japan. It's not really a beautiful picture, especially for the American economy. In 1985, the trade balance was a deficit of $46 billion, and by 1995, it grew to a $59 billion deficit. While the balance had been fluctuating, some years were less, while others were more. It still showcased just how much money was flowing from the US into Japan. One of the ways the US tried to curtail this growth was the Plaza Accord of 1985. The goal of this was to correct trade imbalances by devaluing the US dollar relative to other major currencies, most notably the Japanese yen. Hence, as you can see in the graph right here, the official exchange rate of the Japanese yen to the dollar had appreciated rapidly. Back in 1985, one US dollar was 238 Japanese yen. But just 4 years later, the dollar fell in value, which saw one US dollar to just 128 Japanese yen. The result of this then led Japanese exports to become relatively more expensive abroad, and imports into Japan became cheaper. It may not make sense, so let's put a sample here. For instance, a Japanese car costing 2.38 million yen would have been $10,000 in 1985 at an exchange rate of 238 yen per dollar. But after the yen appreciated to 128 yen per dollar, the same car would cost $18,594. This sharp increase in price made Japanese goods less competitive in the US market, which was exactly what the US aimed to achieve. But there's just one problem with this Plaza Accord. It is the fact that after this was done, Japan had undergone an asset bubble in the 1990s, which some blamed for the contributions of the Plaza Accord. Capital that once flowed into export industries shifted into real estate and stock markets. As the yen's value soared, investors sought new opportunities, leading to speculative bubbles. When these bubbles burst in the early 1990s, Japan fell into what would later be called the lost decade, a period of low growth and deflation. On top of that, there was also Japan's semiconductor industry. In the mid-1980s, Japanese semiconductor manufacturers, such as NEC, Toshiba, and Hitachi, were amongst the largest semiconductor firms out there. Here's a graph on how Japan has surpassed the United States in DRAM sales. DRAM was a key component in the global tech industry, used in computers, servers, and other electronic devices. But, as the graph depicts, Japan had started to fall. Today, it is well known that much of the DRAM market share is held by Korean firms like Samsung and SK Hynix, and little is left to Japanese companies. Another issue that Japan had faced with the US was when they implemented tariffs. In 1987, after investigating complaints from American chipmakers, the US Department of Commerce ruled that certain Japanese firms were dumping DRAM chips in the United States. This led the US government to impose punitive tariffs on a range of Japanese electronics and semiconductor products. Some of these tariffs reportedly exceeded 100% on specific chip categories deemed to be dumped. This had then led many Japanese semiconductor companies to fall. China's economic rise nearly mimics that of Japan. Here's a graph on China's GDP, comparing that to the United States. As you can see, China has caught up to the economic output of the United States. The gap was even clearer in 2021, where China's GDP was $17 trillion, while the United States at $23 trillion. Yet, as you can see from the next couple of years, China's GDP has stagnated. This stagnation has then caused many to believe that China is going to become the next Japan. But of course, this requires more explanation, and it's not always going to be limited to GDP alone. Some comparative examples that we can already see is the fact that, like Japan in the 1980s, China ran consistent trade surpluses with the United States for many years. According to the US Census Bureau, the US trade deficit with China was about $103 billion in 2002, just before China joined the World Trade Organization, and reached a peak of around $418 billion in 2018. The steady increase in imports from China alarmed many American policymakers who worried about the decline of US manufacturing jobs and the rapid rise of China's tech sector. That is where an important person came along, Donald Trump. President Trump, in 2018, had initiated a near similar to what the US did to Japan back then. Tariffs. The US imposed tariffs on more than $360 billion worth of Chinese goods. China then retaliated with tariffs of its own on American imports. This caused a decline in trade balance between the two nations, which, if we take a look at the graph again, shows that from 2018 to 2019, the trade balance had declined from $418 billion to just $342 billion. The similarities of Japan and China are substantial in this case, as having a large trade deficit with the United States served as a primary driver of US policy. That is one of the key policies of Donald Trump, after all. Secondly, there's also friction in strategic industries. Back in the 1980s, the US saw several issues with Japan's dominance in semiconductors, industries that the US considered vital to its economy. Today, China's strides in advanced industries like 5G telecommunications, artificial intelligence, and semiconductors have drawn a similar response. Just take a look at Huawei and ZTE, two companies that have taken a shockingly big market share in the global telecommunications equipment industry. Here's a graph on the global telecom equipment market share in 2023. As you can see, Huawei and ZTE have substantial market share as compared to many Western companies. This wasn't the case 2 decades ago. And again, just like the Japanese semiconductor companies, Huawei and ZTE had met their own challenges. While the US government had different actions aimed at them, it is clear that the overarching goal remains the same: to protect strategic industries and limit the influence of foreign competitors that pose a potential threat to US economic and national security interests. Thirdly, there's also the allegations of unfair practices. Japan, back then, was accused of restricting foreign access to its domestic market and manipulating its currency. The US policy that followed then pushed Japan to open its market to American firms and to change its currency valuation. Today, China is regularly accused of intellectual property theft, forced technology transfers, and state subsidies that violate World Trade Organization rules. While the alleged unfair practices differ in specifics, the underlying complaint, unfair advantage in trade, echoes across both eras. But the two are obviously different by far. They are different in their economic structure. The global value chains at that time were different. Currency issues are also different. Unlike the Plaza Accord, the US is not forcing the renminbi to appreciate. And a big difference was the fact that the US-Japan relationship in the 1980s, despite economic friction, was also strengthened by a Cold War military alliance against the Soviet Union. Japan was, and still is, a key US ally in East Asia. By contrast, the US and China are strategic rivals. So, does the current US approach toward China echo the policies employed against Japan? In some respects, yes. There is an evident pattern of the US taking action to address trade imbalances and perceived unfair competition from a fast-growing Asian economy. The parallels between Japan's economic rise in the 1980s and China's in the 2010s are hard to ignore. Both countries experienced rapid export-driven growth, built large trade surpluses with the United States, and saw their advanced industries challenge American dominance. But anyway, do let us know what you think. Thanks for watching.